Peace to the family. This is the Hood Mystic representing www.hoodmystic.com here with another video. This is Currency Trading 103. Be sure to check out Currency Trading 101, 102 for a feedback. But of course, we'll have some form of a review, and we'll just deal with this information. The title of this video today is called Fundamentals Matter. So peace to you, Mad Titan. We're just going to get it in. All right. Let me see here. So just give you a table of contents of what I'll be talking about today to just let you know whether this is something you want to watch or something you don't want to watch. Obviously, this is a video referencing currency trading. So if you have no interest in currency trading, then this video probably wouldn't serve you any purpose. However, if you have an interest in currency trading, you watch videos about it, still can't get a feel from it because people are very, very confusing and talking about it. That's what we try to do at Coinz and Currentz, make sense of this complicated thing. So we'll have a brief history of the Forex market. We'll talk about the basics of currency trading and the Forex market. And then we'll understand fundamental analysis because the title of this video is Fundamentals Matter. So many times you hear about technical analysis, and technical analysis will be something that we'll be talking about in our next video. However, it's very rare to find videos about fundamental analysis because it requires a different kind of skill set other than like technical, and it's not necessarily about quote unquote making a lot of money. It's about doing a lot of research and knowing about the markets before the markets know about their markets. And so with this video, I'm going to try to explain why fundamentals matter, and I'm also going to provide some links for you to access some fundamentals. So just to let you know, there's a total number of 26 slides, but I guess there's 24 slides left. So 24 slides, and they're mostly images, so it's not as bad as it seems, but it's actually broken up into 3 sections: the history, the basics, and then understanding fundamental analysis. The source for this actual video is taken from Bretton. You see this book in the lower right hand corner, The Art of Currency Trading by Bretton. And yeah, that's the source. And so the link in the description to this video, you can download the PDF of this slideshow just in case you want to utilize the links that I'm showing you to access the fundamentals and whatever. Like we'll be talking about some GDP, we'll be talking about the IMF and things of that nature, and I'll just be giving you guys some links so you can actually do your own fundamental research. So, and finally, join the Coinz and Currentz Patreon page. The link is in the description for that. We're looking for traders, and we're also looking for people that's new. We're trying to create a community of talking about trades, talking about this, and we're a long-standing, long-term community. We're planning on being here. We got people at all different levels of the current, but we're looking for new members. So if you're interested, please join our Patreon page. We giving signals every day. Honcho is going live at 7 p.m. Central Standard Time, Monday through Friday. You know, we got new people that's really sharp. We got, you know, Ra dropping information all of the time. So, and this is all done on Telegram. However, to get access to the Telegram, you would have to join the Coinz and Currentz Patreon page, and the link is in the description, and we'll talk about that a little bit more. So, the history of the foreign exchange. Of course, you could probably go back, but we're not gonna go that back because baby got back. And you know, it's 24 slides, so I'm gonna throw in some jokes here and there just to keep y'all interested. I know we talking a whole lot of new information, and a lot of people don't like new information. They like the hotepery, they like the it's all in your mind and all of these types of things, which is perfectly fine. So when you reference new information, that can be a different and completely different vibration. So let's just deal with it as it stands. And you know, if you want to get further research, be sure to check the book that I mentioned earlier, The Art of Currency Trading by Bretton. So the history of the foreign exchange, we're going to start off with the Medici Bank in the 15th century. One of the most famous, well, I can't say one of the most famous, the Medici that a lot of people might know is Alessandro de' Medici, Il Moro, the Moor, known because he had a dark complexion. He was once the ruler of Florence. So the Medicis were, they opened up a bank, in Florence. And this bank, it had branches in Italy. It had branches in, well, I guess Florence is in Italy, but all throughout Italy and different parts of the world. So when people wanted to travel from point to point, they made this money by selling this holographic bills of exchange, okay? And so just to understand this foreign exchange, we have a illustrative fictional example. The link will be provided in the description in the PDF. So if you wanted to check out the Medici Bank, you could utilize the link in the description. So let's just imagine a merchant is traveling from Florence to London. He buys a bill of exchange for 10 florins with the understanding that the London branch will cash that bill at £0.5 to the florin for a total of £5. If he reaches London and discovers that the florin has become stronger against the pound to the point where a florin buys a whole pound, he takes a loss instead of the £10 he could have gotten if he bought the bill in exchange. So basically, when you travel from point to point, currencies over time change their amounts. And because of this, it just depended. So if I'll just have a more simpler example, I was looking outside and there was a chair on the side of the backyard, and I was on one side of the backyard. If I wanted to buy that chair on the other side of that yard, but that side of the yard didn't accept the money that I have, it only accepted, the chair money, I would have to exchange my money for a whole different currency to be able to buy it. The same way if somebody had pesos, they would take their pesos to the currency exchange for dollars and then buy your products. But say for instance their pesos is worth way less, then that is the art or the beauty of currency trading. So this happened, and then once the founding of America happened, they had the bimetallic standard, which was silver and gold, okay? And this was the monetary system in which the government recognized that coins composed of gold or silver was the legal tender. So whoever had the most gold was considered the richest. Whoever had the most silver was considered the richest, okay? And this was mainly controlled by the UK, Canada, and US until 1933. And then in 1934, the United States Gold Reserve Act happened. And this required that all gold and gold certificates held by the Federal Reserve be surrendered and vested in the sole title of the United States Department of the Treasury. And this made it illegal to even have gold unless it was jewelry. So, this was a crazy time. And then I guess 10 years pass on, and then they have the Bretton Woods Conference of 1944. And this is where all of the countries get together for a gathering, and they sit from July 1st to the 22nd, and they try to come up with a new monetary policy. The reason why it got crazy is because all of the country's wealth was based upon gold and silver. You can kind of understand how unfair it would be to a country that might have had goods and exports but didn't have gold and silver. They weren't able to actually take part in the currency exchange. So around this time, they created a whole bunch of different systems, and this is what created the IMF, or the International Monetary System, and this happened in Bretton Woods, New Hampshire in 1944. So yeah, this created the IMF, and it also created a fixed exchange rate between the 44 companies, but that should say countries, but as we know, countries are actually companies. So the Bretton Woods system required a currency pegged to the US dollar. So the US dollar became the fulcrum for which all monetary systems revolved around, and they based that system on the goal that the United States quote unquote recover into the United States Treasury. So, but this system eventually collapsed in the 1970s, but the IMF still survived and the World Bank still survived. However, what didn't survive is the connection between the United States dollar to gold. What then they began to do is open up trust accounts for people who were born, i.e. a birth certificate and things of that nature, and began to invest your birth and likeness in the stock machine, because they no longer have anything to base the monetary system on, because it's no longer based by gold. And this happened with the Nixon shock in 1971. And this was because inflation was increasing. There were wage and freezes. Imports cost a lot of money. And then obviously he canceled the United States dollar and the connection to gold. And so what that created in 1971 was fiat money. So what is fiat money? Fiat money is a system of national fiat money used globally, and it represents major countries. So every country has a particular currency. And this is much different from cryptocurrency, where there is no country that is backing it. So we got to really understand the difference between the US dollar and things like Bitcoin. There is no country behind Bitcoin. Things like the US dollar is completely dependent on the actual government, but we'll get into that a little later. With freely floating exchange rates between major currencies, a fiat money currency greatly loses its value should this issuing government or central bank either lose the ability to or refuse to further guarantee its value. So fiat money relies on market perceptions, relative value, formal authorization, and paper money, fiat money, is only worth what the government says it's worth. And we'll talk about why fundamentals matter and understanding these things, because there is no true value, only what these small groups of people say what the money is. So the interesting thing is that this information is actually public knowledge, and it can really help you on your trade. So from 1971 on, probably around the 2000s, they began to trade with algorithms or algo trading. But this was happening way before. It just kind of ramped up once the creation of the internet, and then the creation of Ethernet, so forth and so on. 4G, 5G, so forth and so on. And so when it came to successful trading strategies, it wasn't human beings placing in orders any longer. It was simple algorithms and algo trading. And now, for the most part, when you want to put in a trade, it's all done electronically. And now, even more so, a lot of trading that is done by bots or EAs. And it is said that 60 to 40, but I'm imagining a little bit more than that because this book was written some time ago. But when you think about people telling you about how much money that they made in trades, or how smart that they are in trading, a lot of it is due to algorithms, indicators, and all of this is due to technology. So the more that you learn about the bots, the better trader you will become. And maybe having a bot to supplement your income to kind of go along with your human trading, and just to see what's smarter, the bot or me. But in reference to trading, let's just do a quick review on spot currency trading, Forex, or the foreign exchange, all of the same thing. So the basics of current currencies trading, we're going to start with market structure. Market structure and currency trading, how it is done is through over-the-counter market, which is an independent of any centralized system, meaning that your mama can get the application, load some money up into account, and begin to start trading. And you can either lose money or you can make money. And this is much different from the stock market because the stock market is heavily regulated. It's not just so easy to get into the stock market. So within this, we'll be talking about order types on my next screen. And there's a such thing as market execution, where you can buy or sell a currency pair immediately, or you can do a buy stop, sell stop, buy limit or sell limit, and we'll talk about that in the next slide. Another basic of currency trading is understanding volatility. They don't really tell you that when they're teaching you about trading. There's just more about technical analysis. But if the market is volatile, that technical analysis won't work because the market will go up and down in ways for which there is no technical analysis, there is no speculation for. So this is how you measure how drastically the market prices will change. You might know when the market is volatile, place you an order type, and just capitalize on the movement based upon your study. And then you could learn this from actually studying fundamental documents. Liquidity. Liquidity is one of those things that help you with spreads. Spreads allow you to make more money and increase your leverage. When the spread is wide, there is a smaller percentage that you'll make money, and there is like a certain amount of money that you have to make before you can even take money home. But if that's when you're dealing with illiquid pairs, but when you're dealing with liquid pairs, you tend to make more money. So there are, like I said, there are high level liquidity pairs, and then there are also illiquidity pairs, and these things you just have to do your research because you might not have enough money to play in certain games. Microstructure. Now, microstructure is just when these machines are trading at high levels, okay? They're trading in micros, they're trading in seconds, right? They're picking up and they're entering trades and exit out in trades and so quick of a time with so large pip sizes that is just guaranteed to make money. So most human beings can't operate at that high level. So this is another way that machines are kind of winning in this actual thing. So like I said earlier, the order types. Market execution is whether you buy or sell a pair instantly. However, with doing research and doing proper fundamental analysis combined with technical analysis, you can make more smarter buys. And these are different market orders. A buy stop, when the order is placed above and keeps going up. So you know that this chart is going up, but you don't know exactly when. You can place this order below or above. You can place it above or below, but once it goes up, then the market, then your sell, it clicks on, and then you begin to collect your money. Now your trade is active. See, if you would have done it before, it might have went up and down, and you would have lost money. But you do a buy stop, so you don't have to go through all the turbulence of the actual trade. You just wait till it hits your entry point and you make money. And the same goes for a sell. Or it could be a buy limit or a sell limit where you think is going to hit a price and then bounce back up due to your research and due to your technical analysis and then your fundamental analysis. So these are just some of the market orders, which we'll be talking about in later episodes. So further, we're understanding exchange rates. Now, this is one of the most interesting things about currency pairs, because a lot of people are into trading and want to make money, but they can't even tell you what a currency pair is or what even is happening. They're just so caught up in the money aspect, and the money aspect is cool, but I'm more of doing this professionally and being able to help other people do this professionally. And if I'm not able to express a lot of areas, then I'm not going to be able to survive a long time in this business, because I'll be one dimensional and I say, well, I just know how to make money, so you'll do this and do this. And then once I'm not able to make money, I won't know what to do. Or if somebody asks me a question about currency trading, which a lot of people do, I won't be able to even answer it, because sometimes people are so advanced, just the basic understanding of what's actually happening will go completely over their head. So in order to understand exchange rates, is as simple as division, numerators and denominators. We need to remember that the denominator is going to buy the numerator, okay? And so once you buy that, you're now monitoring the numerator to see if it goes up or down. And if it goes up or down, that's going to determine whether you're making money or not, okay? So whatever your denominator is, this is for which you are either buying or selling the numerator. Okay, and it's pretty much that simple. And as these prices go up or down, you'll determine what you want to do. If it gets to a certain point where you're profiting, then you want to sell it for. So if I buy euros with this Aussie dollar rather, and the euro goes up in value, then I can now sell this euro for my Aussie dollars, collect on my profit, and go home and buy my wife a nice house. However, if I buy the euro with the Audi and the price goes down, then I sell it, then I'm going to lose money, and I might have to go into my stash and replace some of the money that I've lost. Okay, that in a nutshell is how a trade works. And I know that sounds simple, but a lot of traders can't even explain that to you. The long and short of the Forex market. A Forex trader taking a long position in a bullish market trading is thinking that the trade will go up eventually. It might go up, down, but eventually, over a particular amount of time, it will eventually go up. And once it goes up, that person can then sell with a profit. Now, when you're taking a short on a trade, you're imagining that trade is going to go down. So then what you do is that you'll simply buy the actual, once it gets to a lower point, then you simply buy with the energy from the numerator. And so numerators, denominators, like math wasn't my favorite subject. I was good at it, but certain concepts are just going over and over again. It can get somewhat confusing, but for the most part, this is why this PDF is available for people, so you can actually look at this and study this and simply understand the difference of what's happening when you actually do a trade. So, all of this is there. The goal, though, is to build up your denominator to whereas now it can actually become a whole number, right? And so that's some division for you. Hopefully you guys got your thinking caps on today. So earlier I talked about liquid pairs. It's really important to understand that Euro USD is the most liquid pairs, meaning that the spread is the smallest and you'll make more money when you actually do hit, and the opportunity to make money is there. And so USD, JPY, GPP, well, the British pound, US dollar, the Aussie dollar and the US dollar and the Canadian dollar, so forth and so on, and it gets smaller. And then they have other illiquid pairs. However, you have to find a pair that you're comfortable with and that you want to study. What will happen is that people will give you trade after trade to make. This person will tell you to buy and sell the same stuff. If you probably have two people sending you signals, right? And they'll say, USDJPY, buy. And then 2 minutes later, the other person sends you the signal and be like, USDJPY, sell. So now you have two people sending you contradictory signals, okay? That will happen more than not. Meaning that it's real easy to say I have signals and I'll get you money and pay this amount of money a month. But it's harder to actually do the work and understand what you're actually doing. So what we referenced earlier with the liquid and illiquid markets, the difference between Bitcoin and the difference between Forex markets is that Bitcoin is an illiquid market. The spread is high. If you have thousands of dollars and you're willing to trade and make a lot of money and catch its upswings and things of that nature, go ahead. But if you're trying to do day-to-day trade with a couple of $100, you might be wasting a lot of money and a lot of time. So, learn about the liquid markets in Forex, learn about its positions, get you a nice study Euro USD, understand its markets, understand its quiet times, understand its fast times, and make some money. So, decentralized markets. The Forex markets are decentralized, like I said, meaning that you, your mama, your cousin can get an application and start making some money, start getting into some trades, start learning about this, open up a demo account ASAP. But it's split into retail and wholesale markets. Now, no matter what type of person you're dealing with, and they talking about, oh, I made this amount of money, I made that amount of money. The banks is making millions upon billions of dollars a day, and they ain't flashing no money. They ain't saying nothing about it. So understand, it's real money to be made, but it's to be made in business, and it's to be made on the hush. And hopefully you doing everything legit once you get your money and filing taxes and things like that. So the retail markets are for individuals, people like you and me, people that's in small shares. Even if you getting $10,000 a day, that's still small considering banks trading millions and billions of dollars a day. And these is found in the wholesale markets, which is for companies, investors, banks, and large shares. Okay. And this is what I talked about earlier about the normal spread versus the wide spread. A normal spread would be something like Euro USD, and a wide spread would be something like Bitcoin. And the reason why you want to have a normal spread is because it's easier to get your losses in order with risk management, and it's easier to make more in profit. And the idea with being a currency trader is not to lose money, but to be in profit. So the more that you can trade in liquid pairs, the more, because there's a lot of hype out here. There's a lot of people that's going to tell you a whole bunch of shit, do a whole bunch of other shit, but it's not going to be a lot of people to show you how to make money, unfortunately. So it's really important to have a mentor. It's really important to have a group that's willing to talk about things with you and help you grow in this Forex thing. And it's not something that you go and accomplish overnight. I've been reading a lot of articles and reading a lot of books and watching a lot of videos. And a lot of people say it takes at least a year. So that's why the Coinz and Currentz teams is here, because we're going to be doing a lot of research within this year. In the upcoming years, we're going to be reading books. We're going to be breaking down fundamental analysis. We're going to talk about the central banks. We're going to be talking about the IMF releases and all of that. So understanding fundamental analysis. This is really something that people don't really get into, and I'm just telling you, Coinz and Currentz, we really gonna get into it. So if you interested in joining the Patreon page, please click the link in the descriptions. Please join us. Please check it out. This is just the first of many videos. We're going to do a video a week. Every week I'm studying something. Every week I'm learning something. So if you can't count on anything, you can definitely count on that. So this is something to learn. This is something to grasp. This is something to understand. And this is something that we should learn together as a family. We should help each other out on this. And one of the things that we're going to be talking about, we got about 6 more slides left. I appreciate y'all for rocking with me. I appreciate y'all for trying to stick with me and learn new information for those who still sticking with me. So yeah. Market structure and fundamental analysis. Market structure is the things that move the market, what allows the market to thrive and grow. Most trades are done by banks, meaning that everybody on the internet, flashing money, that ain't nothing. Like, the real money is made by the bank. So if the banks decide, hey, we about to be done with this Forex stuff, we just about to just hang it up, then the market will have no liquid whatsoever, because it's all about people who are buying other currencies. And then, say for instance, you buy other currencies, you're not buying other currencies just to trade it. You buying other currencies so you can buy something in their particular currency. Okay. And that's why a lot of cryptocurrencies and things like that, commodities, are able to be traded, because you can take commodities, you can take cryptocurrency, and then buy goods and services in different countries throughout the world. Corporations and hedge funds. Now, corporations and hedge funds, they drive the market as well. They're making money. Okay. And I really want to say this to my people, right? If you making money, right, and you saving it, you losing money. If you got a savings account right now, you losing money, okay? People who make money, they invest their money, because their money has to grow. They take some risks. Of course they take some risks, but they learn the market, so that risk is a smart risk. Anybody who's making money, whether you got a job, whether you got a business, if you don't have no form of investment, then when crisis hits, your ass gonna be sitting here scratching your head. See, a lot of businesses don't make money. A lot of corporations, a lot of hedge funds, a lot of investor capitals, they simply invest their money, okay? Because that's the name of the game. And if you're not investing, then what is your money? Like, you have no way to grow it, okay? And so corporations and hedge funds, they buy and sell currencies daily, okay? As a way of growing their money, as a way of understanding the market structure, or even providing a market structure for people like me and you to be in the opportunity to make money. And the reason why, because remember when we were talking earlier about Bretton Woods and Nixon and the fiat currency, the US dollar is the major currency. So all oil can only be bought with the US dollar. So what companies have to do is to take their local currency and convert it to the US dollar simply to buy oil, okay? So these things are happening, right? And this is what's moving the market. Hedge funds. Hedge funds are basically bots that are attacking the market, right? Making sure that they make money, okay? And you can start a hedge fund right now. You just have to buy the bots to make the money. You and your friends can get together right now, right? And create a whole system where a machine is making money for y'all. It's called a hedge fund. And they use investor capital. See, it takes money to make money, though. See, what do I mean by it takes money to make money? The more money you have, the more leverage you can have within a particular investment, okay? So if I don't have a lot of money, then my investment time is shorter than a person who does have a lot of money. And as the market volatility and liquidity operates up and down, the person who has the most skin in the game can survive the ups and downs of the market. And once that market rises, he capitalizes. When that market goes down, he capitalizes or she capitalizes. Why? Because you can sell the money that you have. And once you sell that money for a profit, or you sell that money for a loss and it creates a profit, then that's always money made. And this is why the market is so valuable. You can make money whether the value of energy goes up or the value of energy goes down. And so you have discretionary and macro, and these are short-term hedge funds. Like I said, bots doing a lot of the work, making money by the millisecond, okay? Fast money, okay? millisecond. It's so crazy, right? Right? It's so amazing, the world that we live in, and how easily accessible it is for us to actually tap into these things. But then the perpetuation of, racism, sexism, and things of that nature, when you fall into these particular situations, there is no racial background check. There is no background check whatsoever. Like I said, these energies are decentralized. So you can do your research on CTAs, mutual funds, algorithms, real money, and high frequency trading. Just different levels of automatic trading and trading with bots. Central banks, okay? Central banks actually create the market structure by increasing and decreasing moral rates, moral suasion, FX intervention, Forex intervention, and diversification. Moral suasion is more or less influence. Like, I think that these accounts need to go up, or I think that these interest rates need to go low. And then if the market doesn't respond, they do something that's called Forex intervention. Retail traders, me and you, right? The speculators, the day traders, the real people getting it in. You understand? So let's do some tips to successful trading. Okay. Watch a market for a month. Understand how it flows. Understand its volatile periods. Understand when it's most liquid. Really get intimate with a market. Understand how it goes, okay? And by the time you get comfortable with a market and you placing your trades, you're going to be in a nice flow. You're going to understand its bottoms, its resistances, its support. Study, pay attention. Right now, I only pay attention to one pair, and that's Euro USD. It's a lot of things that's going on around me, fam, but I'm really just studying one market, and then after that, I'm gonna study another market. But for the most part, when you're new in this, you gotta really just study. You really gotta get acquainted, and you really gotta get comfortable with new information. A lot of people get into this, they want to jump in, know everything, make a lot of money instantly, and if that's your bag, then that's your bag. But here at the Coinz and Currentz, we gonna be doing this a year from now, after everybody done made all their money and blew it and tried to do it again and lost all their it's crazy. So slow and steady wins the race, and that's just basically how it goes. But when you study a market for a month, you understand its quiet times, you understand its fast times, and once you understand its times, you can really monopolize and take and capitalize on the market. And even then, you still never know what a market is going to do. This is why there are so many tools to help you actually succeed in this, but a lot of people are not going to tell you because they want your time, energy, and money. Understanding the times of the market, okay? 6 a.m. to 11 a.m. Eastern time. Understand what happened early in the morning. So a lot of speculation can be done by studying the London session, which happens at 2 a.m. to 3 a.m. okay, Eastern Standard Times. This is what's called an intraday pattern. Now, an intraday pattern is when the trades is happening in London, right? When people wake up in New York, they tend to follow what happens in London. And this pattern is very persistent, okay? What are we trying to do with this video? We're trying to teach you a 5-star setup. We tired of you just going into trades with technical analysis and no fundamental analysis and coming up short on all your trades. Following signals and coming up short on all your trades. So what we want to do is give you the possibility of coming up with maximum high probability trades where all of your planets, all of your stars are aligned. So one, fundamentals. Fundamentals matter, okay? What are fundamentals? Fundamentals are the macroeconomic factors that drive the money. The central banks, the interest rates, all of the shit that nobody's telling you on YouTube, right? All they telling you is heads and shoulders, right? Heads and shoulders, right? Oh, I think it's a buy. Oh, I think it's a sell. You see this right here? Oh, yeah. You do that, it don't work out for you. Why? Because you don't know about the macroeconomic factors. And there's a lot of macroeconomic factors in this day and times. So positioning and momentum, like we talked about earlier, understanding your order types, understanding your buy stops, understanding your sell stops, really preparing and plotting out a major sell. Stop, tiddlywinking, playing around with this. Really set up your trades, really organize your trades, be able to speculate a downtrend, be able to speculate an uptrend, and use your algorithms, use your indicators, use your bots, okay? Use your bots. Understand this market, okay? Understand the global drivers of the Forex market. Understand everything, right? Especially if this is a business, right? If you want to gamble, right, and make a lot of money and buy some shoes and then start a YouTube channel like, look, y'all, I made all this money trading Forex, right? That's not going to help you when it's like when the market is doing things contrary to your technical analysis. It's going to throw you off. However, if you can combine your fundamental analysis with your technical analysis, it makes you an even stronger trader. What else is helping you? Global growth, global risk appetite and risk aversion, geopolitics. It's a lot of politics that's happening, a lot of international politics that's happening. So by not knowing it, but then wanting to trade, you shooting yourself in the foot. Monetary policy. What's happening with the money banks, right? What's happening with the IMF? If you don't know and you setting trades, you possibly shooting yourself in the foot. And why is this you shooting yourself in the foot? Because all of these documents is publicly available. Oh, I don't feel like reading that. Oh, but ain't this your business and ain't you serious about trading? Or you not? You just want to gamble. And if you want to gamble, just realize that's what you're doing. Sometimes you're going to win. Sometimes you're going to lose. Currencies react strongly to central banks' change and bias. Okay? The currencies react strongly to the central banks' change and bias. So because of that, it might be a little bit more difficult than you think, but it's still manageable. All you have to do is do the work. Okay, family? 23 out of 26. Thank y'all for sticking with me. Politics influence the central bank. So some banks are hawkish versus dovish. Hawkish means that the banks are positive for the currency of the country because currency is completely dealing with these central banks and how they feel about it, period. Okay, there's some other factors and we'll get into it after this slide, but for the most part, the central banks is saying, hey, we feel real good about our currency. That's it. Because all of the energy is in these particular stock markets with your birth certificate. That's why they can give you money now. It's like, where does money come from? They're just cashing in on their loans, okay? So the interest rates, if they go negative, then, that might stimulate an economic growth. That might prevent excessive deflation, and this is hawkish or dovish. So when you read in these reports on the central bank, you can refer to this. They might say, oh yeah, Canada is really hawkish towards their interest rates. Okay, now okay, this is going to affect the currency in this way. It's going to be positive for the currency. Okay, or if it's dovish, it's going to be negative for the currency. So interest rates make the Forex world go round. In other words, the Forex market is ruled by global interest rates. Okay, it doesn't say that the Forex market is ruled by technical analysis. Okay, so watching things on YouTube and thinking that, oh, why doesn't my technicals never hit the way I want to? Did you pay attention to the interest rates? No? Okay. A currency's interest rates is probably its biggest factor in determining the perceived value of a currency. So knowing how a central bank sets its monetary policy, such as interest rate decisions, is a crucial thing to wrap your head around. And what I mean by wrap your head around is meaning that you have to learn information. You have to learn new information. And this is very difficult. It's not easy. It's not easy to be vulnerable because we want to be the smartest person in the world and we want to grasp everything naturally within the first couple of days. But something like Forex might take you a year. Okay, it's like a decentralized market is like you going to college on your own and learning on your own. Of course, there are institutions that can help you, but 10 times out of 10, they just want you for your money because everybody learns differently. Okay. And get you a team. So be sure to download the PDF for this video so you can get the links for this video. And so with this is we're going to talk about fundamentals and trading the economic data. And so this is the last slide, family. Y'all really the champs. Y'all really the MVP. So real GDP, gross domestic product. Give me 1 second. Give me 1 second. So why is real GDP important? The Federal Reserve uses such data as the real GDP and other related economic indicators to adjust its monetary policy. Okay, and the link for which you can get this from is right here, www.bea.gov. Okay. M2, money supply. Why is that important? Economists and others use M2 data to predict cyclical economic recessions and recoveries and expected changes in stock prices, not to mention expected changes in the Fed's monetary policy. Where can you find that at? www.federalreserve.com/releases/A6. Download the PDF. The link is in the description to get all of this information. Check all of this information when you wake up and you start your trades. It ain't gonna hurt to have a notebook and keep aware of the Fed's monetary policy and things of that nature. Consumer price index. What is the consumer price index, you ask? Why is that important? This statistic is the best indicator of inflation that we have to rely on. It is particularly closely scrutinized by financial economists now since it shows inflation to be at a 16-year low. Changes in inflation can spur the Fed to take action to change its monetary policy. Okay? Just things to be paying attention to when you're making your trades. Producer price index. Why is that important? This index is timely because it is the first inflation measure available in the month. In addition, by watching crude prices, which are the first in the chain of prediction trends, one can sometimes spot inflation in the pipeline before it shows up in the CPI. Link available. Of course, you can Google search all of this as well. Consumer confidence survey, and then we finish. This statistic is a leading indicator of consumer spending. Consumers are more inclined to spend money when they are feeling confident about their financial and employment prospects. And to get a detailed list of this consumer survey, you can go to www.conferenceboard.org/data/consumerconfidence.cfm. Okay. And these are the things for which we're going to be talking about and building in our Patreon page. Coinz and Currentz is me, Ra Supreme, Honcho. We all working together on this. We have a Telegram page where we're giving signals. We're shooting out videos. We coming out with playlists. And we're going to come out with more videos like this. Like I said, the goal is to have 44 videos. 44 videos, 44 subscribers. And once these subscribers get into the coins, and once y'all all get in there, we ain't gonna be doing no more videos on YouTube. We gonna be doing strictly videos, strictly for our content subscribers, strictly just dropping information. So if you like this video, give us a thumbs up. It really helped with the algorithm. Share this video. Be sure to check out 101 and 102. This was 103. Fundamentals matter. In 104, we'll be talking about technical analysis. We'll be getting down and dirty. I really thank y'all for really sticking with me. I know this wasn't easy to listen to, but hopefully it was entertaining. Hopefully it made sense. And hopefully you were able to click the link in the description and join Coinz and Currentz, our Patreon, so we can build further. Thank you guys. Thank you guys. Thank you some more. And yeah. Catch you on the flip side. Catch you on the next video. Everybody.